Happy Friday and welcome to Mortgage Markets and More. As always, I am your host, Peter D'Angelo. I hope you're doing well and that you enjoyed the first full week of December and that all of your Thanksgiving leftovers have now been thoroughly enjoyed by the family. I have your update today for interest rates as well as some things happening in the markets that will be important for you to know about heading into this weekend. And also, as you're putting together those New Year's resolutions, we're going to go into some of the projections that were released this past week as to where interest rates are expected to be going in 2025. Before I get into that, just a couple housekeeping items. We may be changing the cadence of this podcast to be released on Mondays in the new year. My thought process behind this is to provide you with a full week's worth of economic data and all the goings on of the week prior as you head into the new week. And I may pepper in just a quick update before the weekend if there's anything that's appropriate there for Fridays. But having the exhaustive review like we have been doing on Fridays, but doing that on Monday. This way you have the full slate of what happened and we have the full slate of what's coming for the week ahead. Also, I'm excited to share that we're going to start having special bonus episodes with interviews come next year. So it's not going to be a regular schedule, but subscribe to the show on your platform of choice. And then when we have these interview episodes updated, I will be releasing that out and sharing it on socials and everything like that. Without further ado, let's talk about interest rates. We've got some good news here. Maybe Christmas is coming a little early. Let's take a look. 30-year average fixed rate mortgage is at 6.84%. 15-year fixed rate mortgage is averaging 6.01%. The 30-year jumbo fixed is at 7%. The 30-year FHA is averaging 6.18%, and the 7/6 SOFR adjustable rate mortgage is averaging 6.75%. Overall, all of these rates are down slightly from last week. We're seeing a little bit of improvement. Why is that happening? Well, let's take a look at what's going on in the bond market. That's one component. And then there's some other things that have happened over the course of the past week. First and foremost, we take a look at our 10-year Treasury yield. That's the closest market indicator to mortgage rates. That's at 4.217% currently, down just a touch from 4.24 last week when we reported out. The 5-year Treasury yield is at 4.11%, pretty much flat from last week. And the 2-year Treasury yield is at 4.17%. So the bond market's relatively stable. We're not seeing big swings happening, and that creates some stability and removes some of the volatility from interest rates. The big economic indicators that are really having an effect on the interest rates currently are the following. First and foremost, jobs. The ADP employment numbers, which ADP is a payroll provider. Every month they release the amount of new jobs added in the private sector based on their platform and the people that they have who are adding people to their workforce. That came in at 146,000 new jobs added. That is slightly lower than the 150,000 that was expected and quite a bit lower, almost to the tune of 100,000 jobs, down from 233,000 last month. Now, there's a seasonality component to this. Obviously, we're in the wintertime. Hiring can be slowing as people are gearing up for the new year, but this is still a slowdown. And a slowdown in the job market creates more of a case for the Fed when it comes to them lowering their benchmark interest rate, which, as we talked about last week, is already priced into the market. People are expecting, still running at around 60% probability, maybe a little bit more now, of an interest rate cut by at least 25 basis points, 0.25% at the end of December. In addition, we have a couple other market indicators. We're not going to go really too far in depth, just wanted to share this with you because these are things that are affecting where interest rates are right now and expectations for what the Fed is going to do. So we have the S&P Services Producer Manufacturer Index. The U.S. economy is a majority services economy. So if you have a job in the U.S., more often than not, it's in some type of service industry or sales, anything kind of like that. You're in the services sector. That came in at 56.1, below the forecast of 57. Anything above 50 just to give you context for this, anything above 50 is considered expansionary, so it means there's growth happening. And anything below 50 is contractionary, means that growth is slowing, or actually it's going in the opposite direction. You're actually contracting that sector. We're still above 50, it's still in expansionary territory, but it's not as high into that territory as was expected. That also paired with the ISM Services Producer Manufacturing Index. These are just two different perspectives on essentially the same thing. That came in at 52.1, which is below the forecast quite a bit of 55.5. And the previous reading last month was at 56. So we are seeing a slowdown now in these services sectors. So let's put this all together. Slowdown in the services sector. On the ADP employment number coming in quite a bit lower than a little bit lower than expected, quite a bit lower than the month prior. Now there's a little bit more data available to the Federal Reserve when they meet, and they could make a better case now to continue with their rate cutting campaign and cut interest rates by 0.25%. I know last week I said the fundamentals really aren't there, in my opinion, but this type of information, now I can kind of get it. Now I can see it. So we'll see what happens Friday. So when this episode gets released, part of the reason why I want to start doing this on Mondays, but part of what's going to happen tomorrow when this episode is released, we're going to actually get the unemployment numbers. And that is going to be a big data point. And that is also going to be an important piece of information for the Fed to consider when they meet later this month. I'll report out on that next week with next week's episode. We'll also get a good sense of what happened then after this Friday's report gets released. The overall market sentiment is that the market's strong, but they're showing a little bit of weakness. And we talked in the past about the dual mandate that the Fed has. They need to make sure the economy stays stable and inflation doesn't run out of control. They've been working on the inflation for the past couple of years. They've got that down 2.3 last time we talked, 2.3%. Their target's 2. So they're close. Now they're shifting their focus to the second mandate that they have, which is the employment sector. With the cool down in the employment sector, now I can see it. Before, last week, didn't really make sense for a rate cut. Market is doing incredibly well. There wasn't enough there, in my opinion. Now with this data, it could be the case. I wanted to also share with you today what interest rate projections are looking like across a few different sources online. We're going to look at Realtor.com, the Mortgage Bankers Association, and Fannie Mae. And then there's some other experts that I just kind of pulled together. But the top three we're going to look at is what Realtor.com is expecting for interest rates next year, Mortgage Bankers Association, and Fannie Mae. For Realtor.com, they are seeing that the market looks likely that we will see an average 30-year fixed rate mortgage rate for 2025 at around 6.3%, maybe ending the year at 6.2% with the expectation of more rate cuts from the Fed. The Mortgage Bankers Association forecasts a range from 6.4 to 6.6%, pretty close to where we are right now. And that's an upward revision because just a month ago, they were expecting it somewhere around 5.9% to 6.2%. Now that is shifting upward. Fannie Mae, they expect rates to remain above 6%. That's the only guidance that they have. And they actually think that is going to be the case through 2026. But ending 2025 somewhere around 6.3, kind of in line with Realtor.com. And then it runs the gamut. Other experts are saying they could see interest rates at 5%, things like that. The factors that are influencing these projections in the current moment and why we can go from October to now and the Mortgage Bankers Association having such an increase, these are the reasons. One, the Federal Reserve, as long as they're going to be heavily involved with their monetary policy affecting interest rates, whatever they say and do is going to have an effect. Inflation trends. Will inflation continue to stay stagnant and come down, or are we going to continue to see this bounce up and come down as we've been seeing over the past couple years? That's going to have an effect. Job market strength. We just talked about a little bit of weakness. If weakness continues into 2025, well, then the Federal Reserve is going to have more of a case to lower interest rates. That could expedite interest rate relief into 2025. Deficit spending, how much money the government is going to be spending into their deficit, which is going to create more debt that the government needs serviced. More debt means more bonds in supply. We talked about the supply and demand economics to that. If there's going to be a higher volume of bonds out for auction, well, the yield could go higher if the demand and appetite's not there. The one thing helping us is that the world stage is not looking too good. Just this past week, France has a vote of no confidence going up, and that is going to really cripple their government while they have just weeks to finish their budget. That's going to have an effect on the European Union. What's going to happen in the European Union and what people are going to be putting their money in, they're going to look for safe haven assets. The U.S. Treasuries, those bonds, are going to be a safe haven asset. So there could be an influx in buyers. So if we have higher volume of buyers going into the bond market to buy bonds, that will help those yields come down because there's going to be more competition. If these types of things continue, then that can help even if there's a higher deficit spending. But we'll see. This is just to point out it's something that is going to affect mortgage rates in 2025. And then lastly, we're hearing about it in the news every day. I'm getting an email that's giving me an update on what's going on with new cabinet positions and appointments for our incoming president. That's going to have an effect. What is going to be happening politically in this country is going to have an effect on interest rates. With all of this now in our world and in our consciousness, well, it's more of the same for 2025. Well, there's some good news here. I am forever the optimist. Let's look at this in a positive light. We know what we're getting into because of what we had this year. We saw what the interest rate environment was like. We are seeing some progress. It's slow. But every monthly report that we've been talking about, when we look at the National Association of Realtors existing home sales data, it's showing progress. And albeit we have a couple months that are off, but overall, there's progress, slightly more inventory. I'm making a case right now that this expectation for more of the same interest rate environment, which actually I said about a month ago on a podcast. So if you go flip back to one of those other episodes, I did mention this, and it's just dawning on me now. So having more of the same is a good thing because now we can at least know what to expect. The volatility, the interest rates shooting up and coming down, that's been the most difficult thing to manage. That's the thing that gets people in the game and out of the game to buy. If we have a stability, this progress that we're making, no, we're not going to see the floodgates open. We're not going to see a ton of inventory hit. But we'll at least see incremental improvement and progress and some inventory opening up. It's still going to be a very much needs-based market, people who need to sell. But if things are stabilizing, maybe people will be more amenable. They'll be used to what the prices are. They'll be used to what the interest rates are. This could be helpful and beneficial. So, staying optimistic, next year, we're expecting it in the 6% range, and that's great. If we can hang out there, everyone knows what to expect. Lower interest rates would be amazing, but it's just not there yet. And where interest rates wind up landing, time will only tell. And if I can share anything right now, it's more time, a lot more time than what people were expecting. People have been expecting and calling for lower interest rates for years now. People are also calling for recession. We're going to have to see how everything pans out as we go into the new year. But right now, the fundamentals are showing us more of the same for 2025, which is a good thing because we know what to expect. My Did You Know section today, we're going to talk about family opportunity mortgages. This is a very cool mortgage program that we offer at Rate, and other lenders do offer this too, but I've noticed that it's not very common and it's not something that people talk about a lot. Family opportunity mortgages are a phenomenal way that people in the sandwich generation, which is a vast majority of the American population right now, the sandwich generation is actually encompassing multiple generations of Americans that are taking care of their elderly parents and taking care of younger children. And the younger children also could be going all the way up to college age. So that sandwich generation right now is kind of taking care of both directions. this Family Opportunity Mortgage is a pretty phenomenal program that can help both ends and both sides of the sandwich. Here's how. When you have someone who's interested in purchasing a home, we've talked about some of the principles of getting qualified. You have to qualify with credit, income, assets. Let's talk about the Family Opportunity Mortgage for an elderly parent. If someone's retired and on fixed income, they're getting their 401k distribution, Social Security, maybe a pension, that in some higher cost areas where families may be, it may be difficult to purchase a home and qualify based on that. However, the middle of the sandwich, so the American that's there taking care of that elderly parent, they have the opportunity to use this program to purchase a home as if it's a primary residence, getting the benefits of the minimum down payment of 5%, as well as the best financing rate that you can get, which is as a primary residence purchase, and purchase the home for their elderly parent. Doing it this way, as I mentioned, those couple benefits, but there's also the added benefit of the fact that that person who's now residing in that property can be on title to the property as well as the person who's purchasing it. The caveat is that you do need to qualify carrying all of your liabilities. So if you own a home, you're going to have to purchase that other home and carry both of those mortgage payments in your qualification. That could be difficult. However, with most mortgages being serviced right now with interest rates below 4%, it's very likely that you have a very low cost housing expense for your mortgage currently, unless you've taken out second liens, home equity lines of credit. But if, let's say, you just have a primary residence first mortgage right now on your home, you do have quite a bit of opportunity to qualify. And that 5% down, that's compared to the other alternative, which is to purchase a property as a second home, and that requires 15% down. So the Family Opportunity Mortgage is really great in that scenario. Now let's look at it in the other scenario. A parent can use the Family Opportunity Mortgage to purchase a home for a child that is college-aged and attending college. So if off-campus housing is expensive for rent, or if the family would like to invest instead of just wasting money on rent, and they have the opportunity to purchase a home close to the school where their child is attending, they can use this Family Opportunity Mortgage, 5% down, purchase the home, and have their child reside in it as their primary residence. So it works in both scenarios, in both directions. The requirements are that it needs to be a parent or legal guardian. No other family member could be the one to take advantage of this loan program. Other than that, the lower down payment, the lower interest rate is really phenomenal. I myself have been able to use this to help a couple families just as recently as this past year, and it was really phenomenal and it was really helpful. And actually, I got to do it for both of those scenarios. So I had the opportunity. I was fortunate enough to help out a family who was purchasing a home for their mother, and then also another family that was purchasing a home for their son who was going to school. And that's great too, because then you're also teaching your child some responsibility for housekeeping. You're showing them that this is a financially prudent decision so that your money is making money for you eventually. You're building equity in something. And also real estate around college campuses is great to have, albeit could have a little bit of a higher labor component, making sure the property stays in good shape, that you have good tenants and whatnot like that. But overall, good investment opportunity as well. And you get to take advantage of this Family Opportunity Mortgage to gain access to that. That is it for me today. I hope you found all of this helpful and useful. I'm looking forward to next week's update. We're going to see what the rest of the economic data this week looks like, what it does for our interest rates before we get super close to the holiday, and the algorithms pretty much run everything until the end of the year anyway. So I'm looking forward to giving you more information next week. In the meantime, feel free to reach out if there's anything that you'd like to have shared on the show, if you have any questions, or if you'd like me to dive deeper into anything that I discussed today, please reach out to me via email at peter.d'angelo@rate.com. In the meantime, have yourselves a wonderful weekend and take good care.